Greetings, everybody. Welcome to the Liberty Call for Tuesday, March, April 9th, 2022. Hope everybody's having a great Tuesday out there. A little bit warmer today here in the beautiful state of Colorado, but sunny, clear skies, a few clouds here and there. I apologize for being a little bit late. I had to do a grocery run. It had been 2 weeks since I'd been to the store. Had to run by the King Soopers, which is Kroger up here, and the butcher shop to get me some steaks. And I've been fasting since Sunday night, so I am starving right now. So I'm going to try to get through this as quickly as possible. If it's your first time watching, give me a big old thumbs up, a big old like, a share, subscribe, all that good stuff. I would greatly appreciate it. I know there's folks out there who need help, and if you could help them, point them in my direction, I would greatly appreciate it. Anyways, not the best day in the market. See a lot of red here domestically, and it gets greener as we head further towards the, east. So anyways, but let's go ahead and jump in and take a look and see how the markets did today. Dow Jones was down a little bit, down 0.18%. It's currently sitting at 32,744. The S&P 500 was down 0.42 at 4122. NASDAQ down the worst here domestically, of the big indices, down 1.19% at 12,493. Small caps are down more than 1.5%. The VIX today was up 2.25%. It's currently sitting at 2177. Over in Canada, they were down 0.46. Brazil was up 0.23. Mexico was down 0.24. Jumping across the Atlantic, Germany was down 1.12%. The UK was basically flat at up 0.08. France down 0.53. The Euro Stoxx down 1.11. Netherlands down 1.5. Spain up 0.48. Italy down 1.05. Switzerland down 0.3. And Portugal up 1.34%. Headed over to Russia, the MOEX was up 2.32, the RTSI 3.02, which I'm not sure why I even give the Russian stats because can't even trade Russian securities right now thanks to everything that's going on right now. Moving further east over to Asia, Japan was down 0.88. Let's see, the Australia was up 0.13, New Zealand up 0.79. Over in China, the Shanghai was up 0.32. The SZSE component up 0.23. The China A50 basically flat at up 0.04. The DJ Shanghai up 0.28. And the Hang Seng came in, it's alone down in the Chinese markets, down 0.21. And the Taiwan weighted came in up 0.2. So yeah, like I said, lots of green in the Asian area. And then as we got into Europe, a little more red, and then here in the U.S., just lots of red. All right, so not the best, but again, if you've been watching along, this is not surprising. We're probably going to go through a lot more of this downward motion than we will an uptrend, just simply because we're due for it. You know, we should have gone through this market downturn back in 2018, but you know, the powers that be decided it made more sense to print 40% of the money supply or create 40% of the money supply and dump it in the economy, which, hey, may just feel really good. That heroin is really, really nice while you're shooting up. But I think now we're going to go through a lot of detox. So anyways, all righty, let's see here. Let's go ahead and read through today's market recap. Stock market today, Dow stumbles on Micron warning, inflation data eyed. The Dow slipped Tuesday ahead of a fresh update on inflation after chip maker Micron's profit warning weighed on tech stocks. Micron Technology forecast negative free cash flow for the second quarter, driven by a fall in revenue as weaker PC and video game sales is expected to weigh on chip demand. Its shares fell more than 4%. The warning from Micron came just a day after NVIDIA also warned on performance and triggered a sea of red across chip stocks, dragging the broader tech sector deep into the red. Consumer discretionary stocks were on the back foot, weighed down by a plunge in cruise companies and retailers following weaker than expected results. Norwegian Cruise Lines reported second quarter results that missed Wall Street's expectations and delivered gloom guidance, forecasting the occupancy levels aren't expected to return to pre-pandemic levels until next year. Well, I can answer this question. I mean, My wife is someone who loves to go on cruises, especially the Disney boats, and they don't let anyone on who isn't vaccinated. And I am one of those people. I will not put that crap in my body. And, so I can't go with her. And so she has to go either alone. And so I imagine that's really probably a big part of it. There's a lot of us out here who are less than impressed with how that rolled out and are in no hurry to, I've survived this long without catching it. So anyways, let's jump back in. Ralph Lauren fell by more than 4% after the let me jump back. Royal Caribbean Cruise Lines and Carnival were down more than 5%. Ralph Lauren fell more than 4% after the luxury retailer, after reporting fiscal first quarter results that topped analyst estimates, but warning that a strong dollar will prove a drag on revenue growth in 2023. I don't know if that strong dollar is going to last till then. Signet Jewelers slumped 11% after slashing its second quarter and full year guidance on weaker than expected July sales as red hot inflation continues to put the squeeze on consumers. Allbirds also cut guidance after flagging a slowdown in consumer spending, sending its shares more than 19% lower. Energy stocks, meanwhile, bucked the broader trend lower, even as oil prices paired gains on fresh hopes for a breakthrough on U.S.-Iran talks to provide the 2015 Iran nuclear deal that would pave the way to bring much-needed barrels to the market. Well, how about we just stop being a pain in the butt to Iran, let Iran and Israel solve their own problems? It's not ours. I understand the Israelis love to fight wars, especially when the Americans are backing them up. I said we stop helping them and let them solve their own problems. All right, jumping back in, ONEOC, Marathon Petroleum and Occidental Petroleum Corporation were among the biggest gainers, with the latter supported news that Warren Buffett's Berkshire Hathaway increased its stake in the oil giant to over 20%. The two-day wobble in stocks came just a day ahead of July's inflation report, which many believe could show inflation peaking and dissuade the Federal Reserve from stepping up the pace of monetary policy tightening. Economists are forecasting that the pace of inflation slowed to 8.7% in the 12 months through July from 9.1% in February. We shall see. I personally, if I was going to bet money on what the report's going to say tomorrow, I would guess it's probably going to be more of the same. So it may have pulled back a 0.1% or something like that, but I wouldn't expect anything major at this point. Again, could be wrong. I don't have any clairvoyance or anything. It's a from the bottom of my gut kind of guess. All right. Next up on the docket is oil prices, or oil in general. U.S. oil refiners, pipeline companies expect strong demand through the rest of the year. U.S. oil refiners and pipeline operators expect energy consumption to be strong for the second half of 2022, even though analysts and industry watchers have worried that demand could falter if the global economy enters a recession or high fuel prices deter travelers. The company outlooks suggest a stronger view than recent data showing weakness in U.S. fuel demand, particularly in gasoline, where consumption recently hit its lowest level since February, even though this is the middle of peak summer driving season. U.S. gasoline product supplied over the past 4 weeks recently fell below the 2020s level for the same time of year, when the United States was in the depth of a pandemic. Well, the government called it a pandemic. I would call it, just a cold. Energy companies, including Energy Transfer and PBF Energy Inc., say energy demand will remain strong in the second half of this year, according to a Reuters review of company earnings calls. Quote, management sees what's going on the ground, so anytime they're calling out positivity when demand data has been showing otherwise, we find that interesting, end quote, said Kian Hidari, an analyst at Tudor, Pickering, Holt & Co. Quote, it's still a strong environment for gasoline compared to historic levels, end quote. U.S. refiners are also benefiting from high exports of transportation fuels to Latin America, and plants are expected to run high utilization rates to restock inventories that were drawn down when fuel supply cratered earlier this year. Refiner exports of finished petroleum products were largely in line with 5-year seasonal averages at 3.02 million barrels per day in May, the latest data available. According to the U.S. Energy Information Agency, that was nearly 65% higher than the pandemic low reached in May of 2020. U.S. oil output has recovered to 12.1 million barrels per day, helping boost pipeline and terminal volumes for many midstream companies for the second quarter of the year from a year ago. Energy Transfer reported a stronger than expected second quarter performance and boosted its guidance for the rest of the year, said co-chief executive Thomas Long. Of 16 midstream companies that reported earnings last week, more than half revised guidance higher, said James Mick, portfolio manager at Tortoise Capital Advisors. The 4-week average of implied demand for gasoline fell to just under 8.6 million barrels per day in the week to July 29th, the lowest since February, according to the EIA data, though weekly figures can be volatile. Quote, we are constructive on the outlook for transportation fuels, supported by low product inventories and healthy global demand, end quote. HF Sinclair Corp Chief Executive Michael Jennings said on a call with analysts on Monday. Inflation is soaring this year, but with U.S. job growth unexpectedly accelerating in July, economists are less worried about an impending recession. The only U.S. refiner to note some demand tapering in its earnings call was CVR Energy, Inc., specifically in Mid-Continent, which includes states such as Kansas and Oklahoma. Hidari said, the company said it has seen some demand destruction as consumers shy away from driving because of retail gasoline prices that have reached over $4 per gallon. Yeah, and I was just out and about, like I said, and diesel is still over $5 here in the beautiful state of Colorado, at least at the stations I drove past on the way to and from my house. So it's not great out here, and I don't drive unless I really have to, or I take my wife's car, but she's out of town right now, so I had to drive my truck. Alrighty, next up, U.S. productivity posts biggest ever annual drop in the second quarter. This is not good news if you're hoping to avoid recession. Excuse me. U.S. worker productivity in the second quarter fell at its steepest pace on an annual basis since 1948, the Labor Department said on Tuesday, while growth in unit labor costs accelerated, suggesting strong wage pressures will continue to keep inflation elevated. Non-farm productivity, which measures hourly output per worker, fell at a 2.5% pace from a year ago. It also declined sharply in the second quarter at a 4.6% annualized rate after having declined by an upwardly revised 7.4% in the first 3 months of the year, the report showed. Economists polled by Reuters had expected productivity would decline at a 4.7% rate in the April through July, June period. Excuse me. Large shifts in the composition of the U.S. workforce in the wake of COVID-19 pandemic have made it harder to measure underlying productivity growth, which some economists put at about 1% or less, making the Federal Reserve's fight against inflation more difficult. Hours worked increased at a 2.6% rate in the second quarter. Unit labor costs, the price of labor per single unit of output, rose at a 10.8% rate. That followed a 12.7% rate of growth in the first quarter. Unit labor costs increased at a 9.5% rate from a year ago. An acute shortage of workers is boosting wage growth. There were 10.7 million job openings at the end of June. Hourly compensation rose at a 5.7% rate in the second quarter and at a 6.7% rate compared to the second quarter of 2021. So yeah, the Federal Reserve, they keep mentioning how this is going to make it harder for the Federal Reserve. Well, the Federal Reserve could have avoided this if they hadn't have screwed up the economy. But hey, without them, who would make our lives miserable? All right, and a little bit of food for thought. This article has to do with taxes and retirement. These states don't tax retirement income. This comes from Yahoo Finance. States vary widely in the way they tax retirement income, so location is an important consideration in financially planning for retirement. Some states don't levy income taxes on any sort of retirement income, while others tax IRA and 401k distributions, pension payouts, and even Social Security payments like ordinary income. Income taxes are just part of the story, however, as some states with low income or no income taxes have high property, sales, and other taxes. Consider working with a financial advisor when you are planning for retirement to make sure you avoid any unnecessary taxes. I know a guy, so if you need to reach out, I can probably point you in the right direction. Most retirement income can be subject to federal income taxes. That includes Social Security benefits, pension payments, and distributions from IRAs and 401k plans. Exemptions include distributions from Roth IRAs and Roth 401k plans. The federal income tax on Roth contributions are paid before the contributions are made. These contributions, as well as any investment gains, can be withdrawn free of federal income taxes after 5 years if you have reached age 59 and a half. The situation is more complex when it comes to how states will tax your income. Many states will have no income tax at all, so all retirement income as well as other income is state tax-free. Most states specifically exclude Social Security benefits from taxation. Some others also exempt retirement account distributions and pensions. Most have a mix of approaches to taxing retirement income. Now that you have a good baseline knowledge of how retirement taxes work at the state level, let's dive into the states that won't tax you at all. 8 states have no tax. 8 states have no state income tax. Those 8 are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. Don't tax wages, salaries, dividends, interest of any sort of income. No state income tax means these states also don't tax Social Security, retirement benefits, pension payments, and distributions from retirement accounts. Even income from securities held in non-retirement brokerage accounts is free from any state income tax in these states. That means retired residents in these states have no worries about paying state income taxes on their income from any source. Another state, New Hampshire, has no state income tax on wages, also no sales tax, which is really nice there, on wages, salaries, retirement account withdrawals, or pension payments. But New Hampshire does currently tax dividends and interest, which are likely to be sources of income for some retirees with assets outside of retirement accounts. Yeah, it's weird in New Hampshire. I went in and most people know I use a nicotine vaporizer, and the one I'd had for a number of years died while my wife and I were there for the Pork Fest back at the end of June. And granted, we were out in the middle of nowhere. And luckily, there was a little vape shop that was on the edge of the little town we were staying in. And, I think I paid $100 for it. Just everything has a price on it, and that's what you pay. It's just crazy. I mean, as opposed to growing up in, Texas and living a large portion of my life in Florida, everything has got, when you buy it, anywhere from 6 to 8 or 9% sales tax on it. So it's a totally different world. When you go somewhere, the price is what it is. All right. The rest of the states take a variety of approaches to taxing retirement income. Some tax all retirement income, including Social Security. Others exempt Social Security, but tax sources such as pensions and retirement account income if retirees' income exceeds a certain cap. But the following states levy no tax on retirement income of any sort. 11 states that don't tax retirement income are Alaska, no state income tax. 2, Florida, no state income tax. Illinois, retirement income exempt, including Social Security, pension, IRA, 401k. Mississippi, retirement income is exempt, including Social Security, pension, IRA, and 401k. Nevada has no state income tax. 6, Pennsylvania, retirement income is exempt, including Social Security, pension, IRA, 401k. South Dakota, no state income tax. Tennessee, no state income tax. Texas, no state income tax. Washington, no state income tax. And Wyoming, no state income tax. Some states that don't appear on the list of those that don't tax retirement income at all are still relatively generous when it comes to letting retirees off the tax hook. For instance, Georgia doesn't tax Social Security retirement benefits. It also provides a deduction of up to $65,000 per person on all other types of retirement income. Also, in Pennsylvania, Social Security benefits and IRA and 401k income is exempt, and the Keystone State does not levy income tax on pension payments for those over 60. Clearly, state taxation of retirement income is somewhat complicated. One of the biggest differences between states is the variety of income caps to qualify for exemptions. In addition, state taxation of retirement benefits is a moving target. State laws change over time. For instance, New Hampshire's 5% tax on dividends and interest is due to be phased out by January of 2027. Until then, the tax rate on dividend and interest income in New Hampshire declines every year until it reaches 0. So the bottom line, 11 states levy no income taxes on retirement income of any source. Others offer resident retirees varying degrees of exemptions from taxation on Social Security, retirement account distributions, pension payments, and other types of retirement income. Some of the exemptions are generous enough that many retirees in those states won't pay any income tax. Details such as the retiree's income matter and vary by state. So it's important to check with the state tax office for details before relocating to save on taxes. Now, one thing I will add in is, I live, everyone knows I live in Colorado now, lived most of my life in Texas and Florida before that. And, whereas You don't have state income tax in those other, Texas and Florida, and then the states we just talked about. But you do pay pretty high property taxes in Texas. Florida was much cheaper because the schools suck. But if you live in one of the major, like Houston, Austin, Dallas, DFW, San Antonio, and you're districted or zoned for one of the major school districts in those communities, you're probably going to pay, at least in Texas, about 2.5% to 3.5% of your home's current value in property taxes every year. So, for example, my house that we sold in Houston 5+ years ago, I think it was valued around $200,000, and the school district and all the property taxes came out to about 3.5%. So, I mean, we were paying between $6,000 and $7,000 a year on our house in property taxes. Versus up here in Colorado, our home, well, we bought it for more than twice that amount that we sold our old house for. But the property taxes up here are just they come out to about 0.5% of your home's value. So, and with the way the home values have just jumped. I mean, my house went from like $500,000, and had gotten up close to 900,000 just in four or 5 years. It started to pull back a little bit simply because the market is starting to cool off finally. But, our property taxes are way low here. Yes, we do have to pay income tax of 4.65% on income, but it's kind of like 6 in one, half dozen in the other. I really don't look at it as that punitive. The state, where that money goes, I can actually see it. Keeps the roads clear when there's snow everywhere. The roads are really nice compared to a lot of places I've lived. And, we have a lot of amenities that I like, as far as like walking trails and stuff like that. So anyways, just some food for thought, depending upon, if you want to uproot from where you're at, where you make your income and, go somewhere else, for retirement. I personally would rather pay less in property taxes because that's probably going to be one of your biggest assets over time is the home that you reside, especially, if you own the property. It's going to continue to go up in value over time. And, the way I look at it is, if I had stayed in Texas and had bought a house, some property out in the hill country, I was still probably going to pay about 1.5% to 2% of the home's value every year. And on a home that was, say, $300,000 or $400,000 out there, if it doubled in value up to, say, $1 million, I'd have to come up with, 15, 20 grand a year just to pay the property taxes. So, again, it's a give and take. And, as far as weather and stuff like that. Anyways, I've been rambling long enough. Most of y'all probably don't care or will probably even watch. So anyways, all right. Well, that's everything I had for today. I hope everyone has a fantastical evening. I'll be back tomorrow on Wednesday, hump day, for the Liberty Call. And if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. You can drop me an email, a phone call, book a meeting, all that good stuff's on there. And there's a lot of cool stuff to read about. Plus, I link my Monday and Friday videos on there. So if you want to go back and watch through the archive, you're welcome to. So, all right. Well, hope everyone has a great night, and I'll talk to you tomorrow.